In this episode of the Dispensary Marketing Podcast, I'm pleased to bring you probably our biggest guest to date, the CEO of SNDL, Zachary George. SNDL is the largest private sector liquor and cannabis retailer in all of Canada with over 180 retail stores. In this episode, we talk about how he was able to take SNDL from the verge of bankruptcy back in 2020, now to a thriving business in 2025, what his levers of growth are for all the companies within his portfolio, and how to effectively build a pricing strategy around cannabis. You're not going to want to miss it. I'll see you there. Zach, thanks for hopping on the Dispensary Marketing Podcast. Welcome to the show.
Thanks for having me, Brandon.
Of course.
Great to be here.
Thank you. So SNDL, largest private sector, both liquor and cannabis retailer in Canada. In your opinion, what are your keys to running a successful company as large as this one?
Well, first and foremost, we couldn't have accomplished any of our objectives without having the right team and people in place. So people are one of our most important assets. But I would also say running a business at this scale really requires a relentless focus on operational discipline, data-driven decision-making, and truly a culture of accountability.
When you talk about culture of accountability, operational efficiency, like what does that tangibly mean when you bring somebody in terms of like, these are the actual tactical things that, you know, people need to continue doing throughout the company to make sure it's successful?
In terms of efficiencies, we're on a journey for continuous improvement in all things that we do. And so you need to understand that the objectives of the company go beyond what may be obvious in terms of your individual role. And individuals that truly understand and embrace that tend to be very successful. And in our company have advanced quite rapidly through the ranks.
Right. So do you have like a specific example where, you know, you maybe spoke to somebody and you had an idea, or the leadership team maybe had an idea of some sort of innovation they wanted to move forward, and then, you know, maybe the people lower down, you know, obviously they're not actually lower, but lower down, you know, wasn't able to maybe, you know, get a proper vision of what you guys are envisioning at the beginning?
Well, I think you got to start with objectives and targets,
Sure.
right? So each one of the companies in our sector will have a somewhat unique and bespoke strategy, and that's really where it starts. What are we trying to achieve on a commercial basis? What are we trying to achieve for our investors and our stakeholders? What are we trying to achieve for our teams? And then you need a really strong governance overlay, and that's really going to dictate the levels of integrity and the rules of play. How are we going to show up? How are we going to execute? And then the third element is really execution. If you don't have accountability, then the failure to reach certain objectives or the failure to adjust when things happen, when a certain path is derailed, it's very difficult to recover from that. And so tying specific operational and performance objectives to compensation, for example, is a critical element for that accountability. The notion that our teams, myself, others, should be increasingly successful and awarded compensation while missing targets set by the team is really the antithesis of accountability and something that we would avoid.
How do you determine long-term goals versus short-term goals, and then how to compensate appropriately to make sure that it's not too short-term thinking versus too long-term thinking?
I think you just nailed one of the trickiest issues that senior leadership and actually a board of directors faces. You need to have a long-term and sustainable strategy, but if you don't execute well and show progress in the short term, especially if you're a public company with significant scrutiny and illicit equity, you can really destroy your cost of capital and end up putting a lot of pressure on the business because of that lack of execution in the short term. One of the things I've observed over time is that some individuals, some leaders will use the language of long-term focus to justify and excuse, you know, poor short-term behaviors and performance, and that's really just unacceptable. So it's a tricky balance, but one that has to be reached. And in our case, we've been able to execute on both. When you look at our last full year of performance, our last quarter, we're clearly demonstrating that we can both reduce our costs, drive efficiencies while growing the top line and expanding margins. And that's a very, very difficult task, but our team is achieving it handily.
And is it as simple as saying, hey, we need to reach X revenue, X profit under X expenses, and then it just trickles down from there from leadership and everyone under that? Or do you need to be a little bit more direct in terms of seeding the vision as to what actually needs to happen and the direction that we're going to go to? I would love to kind of, later on talk about kind of the growth levers, which I think is very fascinating on any scale of business. But in terms of just like overall general overview, is it literally we need to reach X, number marks and then it trickles down, or do you need to get a little bit more tactical?
It's both. It's kind of all of the above. So certainly you want to have your senior leadership and your board of directors setting specific macro goals. Some of these will require capital investment, and so making sure that you're prioritizing in the right ways in terms of how you're going to deploy capital is critical. But once you set those targets, we have an annual budgeting process. We're just going into our planning cycle for 2026 this month in September. But that will set a framework that will, the outcome of which will dictate compensation and what our total rewards platform looks like in 2026 and beyond. But within that, there needs to be flexibility. So, for example, we may have Canadian cannabis retail as a top priority and use of funds, so to speak, for investment. But the efficiencies, bringing more convenience to our banners, driving loyalty, choosing the right partnerships with suppliers, middle management, and in some cases junior leadership will help make those calls. And ideally, when things go wrong, because they always do, you're always going to miss something. The market will change, players will change, pricing will change. You have enough agility in the organization to pivot and find solutions and solves to still hit targets despite some of those misses. So, in our case, for example, in 2025, we've seen some tailwinds from growing international demand for products, while we may have been slightly under expectation in terms of our performance in third-party retail, largely because we're a dominant retailer ourselves. And so we have different levers we can pull to bridge some of these issues and still reach our targets overall.
When it comes to like kind of mapping out projections for stakeholders, right? Obviously you have the past of performance of what you've done, but then you also have the future. Hey, these are the things that we're expecting, right? Now, when you're mapping out those projections, is it normally a very conservative projection so that you can meet or exceed the promises that you've made? Is it like an average projection where you have like a higher end and a lower end? Like what is the communication style of like how you actually figure out what the projections are in the future?
It's a great point and very relevant for where we are over the next 60 days internally in terms of our budgeting process. But it is important to, number one, have the right people and then put them in a position to win, but have really high expectations. When you set the bar extremely high, even when you fall short, you likely are making material progress towards future goals. So having really that positive tension of some of your leaders almost being concerned about their ability to hit targets, but also scrambling to find solutions to drive profitable growth through the business is actually a good thing. And that friction, while it may not feel great in the moment, can drive phenomenal outcomes. And I've seen that time and time again through different companies.
Right. So you have a shoot for the moon philosophy. If you fall, you land among the stars, even though the moon's closer than the stars, but you get the point. So that's kind of the growth philosophy that you have is, try to hit these almost not impossible goals, but goals that you maybe deem are a little bit further than you can reach. And, worst case, you'll still be above higher than whatever, baseline.
I don't talk in terms of moonshot language or impossible goals. Let's just say that we have ambitious goals. Let's stop it there.
Very realistic. Fantastic. So I did a bunch of research, ahead of this call. So I went from law school. I believe in a previous podcast, you passed the bar but didn't actually practice law. You went to hedge fund management. I see this really cool article right here. Back in 2004, very young picture of Zachary George at Pirate Capital. The first little paragraph says, Zachary R. George, 27, serious, square shoulder, and wearing some kind of goo in his hair, sits at a long counter of a desk in Norwalk, Connecticut. Walk me through kind of like who Zachary was back then, and who he is now, and how some of those skills transferred from being this, kind of young growth hedge fund manager to, being to where you are right now.
Yeah, that would have been 20 years ago. My background, I grew up internationally. I'm a dual citizen, which is quite relevant to my participation over time in Canadian business. Was born in Texas, grew up in the UK, and then ended up in Canada for high school in the Ontario region. I did graduate law school, passed the bar, never practiced, was originally trained as a credit analyst. So again, I think the maturity that you have either as a young analyst or principal in your 20s is much different than what it would be 20 years later. So I don't think there's much surprise there. But more specifically, in terms of what drew me to cannabis, I looked at this as an opportunity to hold a leadership role in a disruptive, high growth and emerging industry. And certainly, I don't think there's a day that goes by that if you think about the regulatory complexity that exists within this space and more broadly in regulated products, and the amount of stress and lack of available capital in the system, a background in law and to some degree finance. It doesn't have to be a core degree, but you need to have some basic algebra down and understand the juxtaposition and how company performance relates to market activity. Both those skill sets, which I've developed over a long period of time with a real focus on takeovers and turnarounds of public companies, has served me really well in this role over the last 5 years.
Would you say that you like the chaos of these takeovers and turnarounds? And, it seems to me, again, outsider looking in, I don't have very much information or just even experience about the things that you do on a day-to-day basis. But it sounds to me like it's a lot of chaos. There's a lot of movement. There's a lot of different stakeholders. There's a lot of people you need to make happy. There's a lot of people that are not going to be happy with the decisions that you're going to be making. Is that just an environment that you would say you've been thriving in? And it's an environment that you like to be in?
I view chaos as part of life. And I think there's tremendous opportunity, within that chaos. Over the last 30 years of my career, I believe that what's helped me the most is to really build build a pain tolerance for conflict-ridden, sometimes hostile, difficult situations where you may have parties not agreeing. You may have parties that are engaging in bad acts that need to be corrected or fixed. And in this industry specifically, as you mentioned, there are many, many moving parts. There is a bit of a changing, playing field in terms of the regulatory environment. And while you have more THC being consumed around the globe on an almost daily basis, as we know, this is a different version, so to speak, of CPG. It's got its own characteristics. Very difficult to scale when each individual Canadian province and each U.S. state has a different set of rules and regulations, and THC is not really supposed to cross borders. So I think that will all evolve over time, but it is very challenging. And so if you have an eye for complexity and detail, and difficult tasks operating in a business with relatively low margins, I would say it's more akin to what you'd find in convenience or grocery, then it's a very exciting challenge to take on. And, working with entrepreneurs and companies trying to professionalize themselves has been a very rewarding experience for me.
We spoke about it briefly on our pre-call about kind of the tolerance to kind of pain, if you will, right? And you were essentially mentioning that, you do it enough times, you'll kind of get numb to the pain of chaos, right? Now, do you think that the process you followed is the process that every CEO needs to take in order to be successful?
I believe that in order to be a successful leader, you have to absolutely be comfortable with discomfort. Leadership is not a popularity contest. Leadership is not about having everyone agree with you, and being able to stick to a plan, stick to strategy, even when it's difficult, and even when your peers and colleagues may be challenged, and in some cases, even struggling, is very critical to success as a leader. It doesn't have to be exactly the formula that has worked for me, but I would say that those elements are really important for all leadership roles.
On the flip side, you also mentioned breaking down complexity, right? Like really understanding the process to kind of figure out like what are your core bottlenecks. Do you have like an example of like a complex situation that you had to go through, and just kind of your thought process on how you were able to break down this behemoth of a task into actual tangible items? Like, I need to now do step 1, 2, 3, 4, 5.
Yeah, look, there are many examples, or I would say small case studies that we've been through as a business. One would be when you look at the formation of what was in the early days Sundial Growers. There was reliance on a sole core asset in Canada, which was at the time the largest cultivation and processing facility in Canada that was pure indoor, built in Olds, Alberta. So understanding that facility was not going to be competitive with scale cultivation across Canada was a very serious and existential observation, and how we navigated away from that asset to build a successful business, despite the broader enterprise being over-levered. I would say is certainly an example of complexity that we worked through over time, and involved.
Running a dispensary is harder than ever. There are competitors popping up all over the place. So to help you with this, I've talked to 100 dispensary owners from coast to coast, and I developed this 6-stage marketing plan to help you increase your online orders, increase revenue, and also help you have a lineup of people outside your door. So if this is something you want, please check out the links now. So, that kind of brings me to my next question. Back on, when you first initiated the CEO role within SNDL, I think on a previous podcast, you said you were more of the CRO, the Chief Restructuring Officer, verge of bankruptcy, chaos, all the things that you like and enjoy. What were some of the toughest decisions that you had to make in those early months in order to get over this hump?
It's a great question. So this would have been early 2020. And our senior lenders were working to push us to seek CCAA protection. We were trying to avoid what would have been a zero outcome for the equity. So the toughest decisions that we had to make were really around restructuring the business from multiple perspectives. We were going to end up, moving away from the business's core operating position effectively. We were having to deal with significant leverage and lenders that were very impatient, and then also having to rebuild trust with investors. The IPO of the company was in August of 2019, so in a very, very short time frame, the business fell into deep distress because of its positioning, and so there's a certain degree of certainly a strong degree of investor frustration and disappointment within the first year of this public company's life. And so building trust back with those stakeholders is something that we're still engaged in today, still building credibility, still building trust. But we had to make really difficult calls on capital allocation and talent as well, to try to pivot towards a more sustainable business model, which you see the results of today.
How long did it take before, like you said, there's always chaos in business, but how long did it take before you were able to kind of recover pretty much from everything that was happening? Was this like a couple of years? What did that look like?
I would say that you're just seeing it now. And we think that there is still a significant amount of improvement coming from an operational and a performance perspective. And our leadership is focused on all of the right things in terms of accessing material improvement in the business. I've never worked on a turnaround, an operational turnaround inside of a business that has taken less than 2 years. These are long processes. There's a lot of damage and rebuilding that needs to occur. And it's just not something that happens in a matter of a few quarters.
On the retail side, right? 180-ish cannabis stores, 170-ish liquor stores. What are the general levers that you pull to kind of maximize growth? And then I guess the follow-up question on that is growth always the thing that we're always optimizing for, or is it operational efficiency, for example, that will then lead to growth? Kind of walk me through that process.
So the common thread that runs through these businesses is they're both positioned and driven by the consumer's focus on both convenience and value. So That would be the macro comment. In terms of specific focus, we're focused on pricing strategies, product mix, effective store level execution, and increasingly digital engagement as another driver of convenience. Each banner on the retail side has a unique profile and role to play, and we tailor our approach to maximizing our return on invested capital and retaining consumers. So, in terms of growth as a key priority, I would just reposition that slightly and say that what we're really seeking is profitable growth. In terms of public companies, you may say, well, if as long as your profitability is improving, does growth really matter? As long as free cash flow is growing, does the top line really matter? I think if you look at broad sets of data, you'll see that without the combination of both profitability and growth, it's very difficult to be awarded a premium multiple in the public markets, and so that's also very important. It's difficult, but really important. So we were just putting up same store sales in our cannabis retail business of 8%. So we have strong organic growth year over year. But then we've also engaged in M&A as well. We've taken on at least one semi-material at our size, acquisition every year over the last 5 years. This year it'll be a little bit smaller with 1CM that we think will close sometime in the September timeframe. And so we are achieving scale, we are achieving growth, and also improving free cash flow, which at the end of the day is one of the most important metrics to focus on in terms of sustainability and the ability to continue to invest with internally generated capital, so you're not reliant on access to credit and equity. And as we've seen in cannabis, it's very, very hard to come by, whether it's because of regulation or just institutions not having a strong appetite to invest in these companies, many of which have been losing money and have very poor prospects for long-term profitability.
Do you think so? I just finished up an interview not a long time ago with Canara Biotech out in Quebec, and they said they were able to acquire a massive cultivation facility out there for essentially pennies on the dollar because I think the original company spent however much, 27 million or whatever it is. Do you see that money coming back into cannabis anytime soon, or do you think this is kind of like a slower growth play where it's like now cannabis has to prove its worth, if you will, in the market before some of these investors come back in?
If you're talking about this phase of, call it 2018 to 2020, that by all accounts was a bubble. So you had valuations being awarded to companies that had never generated a single dollar of profit or free cash flow. You saw astronomical values being assigned to a number of the Canadian businesses at that time, many of whom have had CEOs and a lot other leadership turnover since that period. I don't believe that lightning strikes in that same manner twice. There may be additional bubbles or waves of capital that come into the space, but I actually don't believe that specific dynamic is going to repeat itself. And it also has implications for other parts of the world, right? Like the fact that you saw this large bubble getting built, a lot of capital destruction on the backside, overinvestment in the wrong assets. These markets tend to very slowly learn lessons. And so when you think about how Europe and South America are going to be built out, it's quite likely that that growth is going to occur with greater discipline and a very different respect for capital than we have seen in the early days around federal legalization in Canada.
So there's a big, kind of talk about, I'm not sure how super plugged in you are into like the American market, but especially with regard to the Canadian market, we're doing it both a little bit differently. Do you think, obviously the rollout of retail legalization, if you will, from the other local dispensary owners haven't been, let's say, the most ideal with regards to giving out so many licenses to people and stuff like that. What do you think about the future about the Canadian cannabis market? Is this something that you're optimistic in terms of the next coming years in the future? What are your thoughts around that?
Yes, we're very positive, and I would say optimistic about the sector. You are going to see growth rates slow. That's sort of a natural part of the evolution.
Right.
You're looking at a market that is a strong contributor to employment and GDP in Canada at a time when it's desperately needed, given the lack of performance generally in Canada. And I would say that we're starting to see a handful of companies execute quite well. At this moment, some of the scale cultivators really look like darlings as they have some tailwinds from international demand. Now, those margins will change and evolve over time as well. But you have a handful of companies that are starting to put up free cash flow on an unadjusted basis quarterly, as well as net income. And these are all great signs for the health of the industry. I would say there's also still way too many operators, just numerically, and licenses out there. I think the question you were sort of referring to was a comparison to some medical limited license markets in the U.S. And those in some ways are not free and capitalist markets, so you can have different views about whether that's a good thing or a bad thing. But we've been through a really aggressive cycle in Canada. We've seen the bottom of the trough effectively. So everyone wants to talk about this race to the bottom. I think in the near term, in 2023 or late 2023, we were actually calling for a bottom to emerge in 2024. And if you look at pricing, both in terms of finished goods and wholesale flower, it looks to be correct. I think what people are not focused on is what does the next peak in the cycle really look like. You're seeing quite a number of cultivators add supply and plant more cannabis for both domestic and international markets. So at some point, we will see another cycle, but the market is rationalizing just as it should. I've talked quite frequently about asking people to look at the nature of industry structure in Canada, whether you're selling financial services, gasoline, airline tickets, consumer goods through grocery. Almost every one of these industries in Canada is some version of a functioning oligopoly. And I think that cannabis is going to be no different. I think you're going to see 3 to 5 strong-handed players, and then a large handful of ancillary operators and service providers in the space. But what we have now really is not sustainable. And we have a lot of small LPs, some of which have great products, but will never have the capital or distribution scale to run a sustainable business.
So kind of on that same note, let's chat value buds, very quickly. Cannabis is already super low margins, regardless kind of how you go about branding, but value buds literally promotes themselves as the lowest cost alternative to, any other dispensary, or, at least they try to, in terms of, being lowest cost to any other dispensary. Is that do you find that a super dangerous game to play, or do you think kind of like the small margin play is the correct play for retail?
Yeah, I can remember back in 2021, 22, value buds and Nova were dirty words in the industry. People were very upset, even going so far as to call for the government to regulate pricing, which is a horrifically bad idea. I'm not sure if I would call it dangerous, but we see in all of these consumer sectors, we do see successful retail models that are trying to offer everyday low prices or best pricing to the consumer. And we do know that, again, convenience and value are the two dominant themes that actually resonate with cannabis consumers. So, look, it's a calculated strategy. We drive volume and loyalty through aggressive pricing, and we're able to offset some of the margin pressure that comes from that strategy with operational efficiency and scale. It's really about becoming a trusted player in the marketplace and a retail environment
that is welcoming and convenient to consumers. So there's two things, two words that you've mentioned a couple times over the course of the podcast. And, I feel when people mention things multiple times, it's quite important. Value and convenience, right? Does value just mean lowest cost, or do you have another associated definition for the term value? I think you just have to remember the adage, right? Is like, price is what you pay, value is what you get. So there can be some overlap, and there's a lot of kind of rich nuance in that difference. But by and large, we see it in terms of repurchase rates, where there's so much, I would say, sameness across products. And that was a big driver for the logic behind the model we've built. I didn't want to kind of stand in the street for a knife fight comparing my infused pre-roll to your infused pre-roll. I think that's a small ball opportunity, and in some ways a fight that's just very, very difficult to win. And instead wanted to be a part of the ecosystem where we could actually partner with competitors and other operators in the space, and that's exactly what we've been able to do. So yes, we absolutely run a low cost model. A consumer needs to understand and expect, right, that when they come to a Value Buds, they're going to see attractive pricing. But we're also not the only discount operator in the market, right? There are a handful of operators doing quite well. The largest of which obviously would be Cabana through High Tide. And so they are seeing similar tailwinds from being able to offer really, really strong pricing to the consumer. And then does convenience just mean opening up the largest number of stores, so then there's a dispensary down the street, or is there another kind of aspect to convenience that you try to optimize for? I think it's multiple levels. It's the offering that you have inventoried. It's how you manage categories. It's access to new products and innovation. It's assistance while you're in store. And then, the next wave of convenience, I think, will really be technology and e-com enabled, right? Where it's not just about how do I transact quickly in store, but rather do I have an opportunity to be shown products, online, learn about them, order for pickup. How do I make the transaction more efficient? How do I transact with the least amount of impact to my day, to my schedule? And I think that's really the next shoe to drop, so to speak, when it comes to the convenience that the sector offers to consumers. So from an overall perspective, I guess when it comes to trying to present as a low-cost alternative, or actually presenting as a low-cost alternative, is it just more so how do I provide the most value to my customers at the best convenience? And then from there, that's aside, everything else outside of that kind of bubble is where we try to save money on, so then we can then provide more value and convenience to the customer. We are very disciplined and have very specific formulas about what works in a store format. We know to the penny, what an average store can sustain in terms of monthly rent. We have a very tight and predictable labor model. When you get any of these elements wrong, you will likely fail as a retailer. So how you inventory, how you manage categories, how you manage real estate and your people are really critical ingredients to managing retail successfully, especially on the discount side. And so our teams are laser focused on those elements and making sure that we're adjusting adequately to the market. So really knowing your numbers. It's important. So No Frills, for anybody who doesn't know, is a Canadian-based grocery chain. Again, low-cost alternative. Value Buds also has kind of the similar yellowish branding. Was this purposeful, in the eyes of the consumer to align yourselves with, like a brand like No Frills? I think also Dollarama also has like the yellow in their branding as well. Was that on purpose to align yourself with, in the minds of the shopper, those sorts of things? So if you're asking about the color scheme and logo, was it intentional? Yes, it was absolutely intentional. I don't want to talk about those banners in detail, but I would say that, we invest in localized marketing. We are building a strong loyalty program, which is giving us really great consumer insights in terms of what's working and how tastes are evolving.
and also an in-store experience that will differentiate our banners. So there's really no connection directly if you think about the experience inside of a No Frills versus a Value Buds. But yes, the design of the banner is very intentional.
We have Value Buds, and then you also have Spirit Leaf on the other side. Effectively, two different brands. How does the growth strategy, or just the overall strategy of managing these two different brands, differ between the two?
I would say it's been an evolution. So we closed the acquisition of Spirit Leaf in July of 2021. It was a mixed bag corporate and franchise model, run very, very differently than Value Buds. So it was really focused on having great selection and choice in store with knowledgeable bud tenders and support for the consumer. Not as focused on discounting at the time. I would say that it was also born during the sort of gold rush phase in the industry. They were opening up doors very rapidly, and I would say that the franchise model in cannabis looks very, very different than what you'd expect in a QSR or fast food, model. And so there's specific challenges with it. So we've had to amend that royalty and franchise structure over time. We have dealt with, because of the pace of growth. Exactly what you think would happen did happen, in the sense that we have some phenomenal, very strong performing, very business minded and successful franchise partners. Mm-hmm. But in some cases, those partners were not vetted well. Mm. In some cases, site locations were not vetted well. And so we spent a lot of time rationalizing the franchise side of that business. And in some case, for corporate Spirit Leaf locations, we actually converted the banner to Value Buds, and we saw material uplift in sales as a result. So these banners both have important roles to play, but they are really different. And I would say that understanding the progression is really important as well. Like, if we had not acquired Spirit Leaf, we would not have been able to engage with Nova and Alcanna to look at further M&A. And so the timing and sequencing of these transactions and the growth of our retail segment is an important part of our story.
Now, looking back at your time in SNDL, what are you most proud of? What excites you most about the future?
Look, I'm proud of the turnaround and transformation that we've led, turning SNDL into one of Canada's largest regulated product platforms. That's very exciting. We have an opportunity. If you look at our balance sheet, if you look at the scale of operations, if you look at our credit portfolio, which is going to bring significant U.S. Operations into focus in the coming months, we have an opportunity to really lead consolidation and innovation across the sector. And in this emerging market that continues to enjoy strong growth rates, I don't think we've even scratched the surface of where things are going with cannabis. Obviously, people are pretty excited about President Trump potentially rescheduling cannabis to Schedule 3 from Schedule 1 in the near term. And I think that's going to drive further research and transformation in the business. We've seen that none of these markets are static, and product evolution is really important. So you've got newer medical markets such as Germany, which are almost entirely flower. When Canada first opened up, it was effectively short dried flower, but also, dried flower was over 50% of the total addressable market. Now it is shrunk materially, and now you see more convenient formats like pre-roll and vapes taking up more than half the market. So I think you're going to continue to see evolution in that product cycle. And I think a big question is, if you think 5 to 10 years out, what role do inhalables play at that point as this product set continues to evolve?
Fantastic. And lastly, please plug all of your information. Where can people find more about SNDL?
Yeah, thanks. So easy to find, SNDL.com. We have quite a bit of content, investor presentations, and all of our press release and financials. And we do have a number of other podcasts and media events that are easily accessible through searching the internet.
Fantastic. Zachary, thank you very much for hopping on the Dispensary Marketing Podcast. And for everyone else who's still listening, I'm your host, Brandon Kwan. And until next time, I'll talk to you guys later. See you.
Thanks, Brandon.
Hey, according to YouTube, this is the best next video for you. Go ahead and click it now.